let's talk about some more helpful tools, and they revolve around momentum. Momentum helps overcome one of our biggest challenges in technical analysis, and that big challenge is detecting when a trend is about to end, or is it a minor pullback? Is the trend ending, or is it really just kind of a minor pullback or minor temporary change and the trend's going to continue? Momentum tools are terrific at overcoming that challenge. So let's talk a little bit about the basic concepts of momentum, and then we're going to share some specific tools that help you later in this section as far as around momentum. So what momentum is at its basic level is it really looks at the speed of a price change. So it's actually relatively easy to calculate. It's all going to be done for you by your platform. But if you think about it, you're looking at the speed of how fast or slow are prices changing. So it looks at basically the today's price, what you could pay today for a security, and what was that price X number of days ago, or periods ago, hours ago, minutes ago, whatever your number of periods are. You're going to compare those two. And then it's going to really look at a rate of change, or a rate of change method, that applies some, simple mathematics and percentages around that. In fact, when you look at momentum on your platform, it might not even call it momentum, it might call it ROC, or rate of change. So for example, if prices are rising fast, the momentum number that you can use to kind of use as an indicator is going to keep getting bigger. And on the chart, a momentum chart, and we'll see some examples of that in a moment, or later in this section, on the chart, it's going to show a rising line, right? So if you see a rising line, that shows prices are rising fast. If the prices are rising, but they're not rising so fast, and the line will start to flatten out, right? So you're going to see that line not be as steep. It's going to start to flatten out as prices maybe are rising, but they're not rising that fast. So momentum is all about the change in price level rather than the level itself. So it's not about the actual specific price so much. What you're really measuring is that change in that speed of that price level. So you might say, well, that's great, but we want more. We want even more. And it does quite a bit more. It will measure the amount of that acceleration of that price change, or deceleration of that price range, depending which way you're looking at it. And then also the amount of that rate of change. Momentum indicators also will eliminate as much noise as possible by looking at those changes. And you can kind of see momentum in the context of an overall price range, that highs and lows, what's momentum doing, what's happening, are prices accelerating, all that kind of stuff. And it can really, really give you a good indication of whether a security might be overbought or oversold situations. Overbought where it's pretty much everybody who's going to buy it at that certain price level has. You might be ripe for a time for it to kind of go backwards or go on a downtrend, or vice versa, where it's oversold, where it's just price has been really pushed to the bottom, maybe real quickly pushed to the bottom, and it's really ripe for a turnaround, and it might be a good buying opportunity for you. So it's an indicator that can really help with that. Is a momentum indicators that we have here can be used really well for that. And a lot of people like to use momentum really more so as a confirming indicator. I like that idea too. So if you're evaluating, it helps you to evaluate the strength of a trend that maybe another indicator is saying there's a trend. So your primary indicator is saying there is a trend, whether it's up or down, there is a trend. And maybe it's something like the confirming a moving crossover, or price, moving average crossover, whether it's price or the two crossovers crossing over each other. You could say, I think there's a trend here. I'm seeing a price crossover. I want to confirm that with this momentum, with a momentum indicator, to see if this is also saying that we might have, a situation for a good opportunity to buy or sell by looking at that price change, acceleration and deacceleration. So that's kind of momentum in a, kind of the basic math concept and what it does, measuring that rate of change. And then building from that basic core foundation of the momentum calculations, there are some powerful tools that have been built on top of that you're going to see in any of these, platforms as far as for trading. And what you really are going to use is these types of indicators. And the two really that stand out are the RSI, or relative strength indicator, and the stochastic oscillator too, which sounds like a fun name, doesn't it? So those lessons are coming up. But those are the key things that build on top of the idea of using momentum to analyze from a technical analysis standpoint, securities. Oh, let's take a brief moment or pause here to talk about the difference between momentum as a technical indicator and momentum investing, because you might have heard the term, oh, that person's a momentum investor, for example. And they're two different things. So let's talk about that briefly. So momentum at its core is an arithmetic or arithmetic calculation, that technical traders are using to, as we talked about earlier, to identify the speed of change in the speed of a trend, or looking at a trend and how much are those price changes going up and down, accelerating, decelerating. It's a technical tool that we're using to really identify that. Momentum investing, as opposed to that, is really about buying a security, and it's an investing strategy just because that security is going up without actually measuring things like the rate of change or using possibly even any technical factor at all. So it's more of a strategy of investing. And the idea behind the strategy is that, well, if something's already rising, the idea is that it will keep rising, or at least for a little bit longer. It's got that momentum behind it. It'll keep rising, for example. Or if the momentum's going downward, it's the same thing where the momentum will be going downward. But you see the difference between the two? In technical analysis, momentum is a calculation, unemotional, just this is what it's saying, this is what the math is saying, and we're using that as an indicator to make buy and sell decisions. Where momentum investing is more of a strategy of like things that keep going up, especially that type of momentum that'll keep going at least for a little while, but it doesn't get into any kind of technical trading. If you could actually be a momentum investor and then try to use technical trading to identify that sell point, might be a way to do it, but they are two different things. So if you're thinking like, oh, momentum means I'm going to be a momentum investor, not at all. It's a tool that you can use with any type of investing strategy or trading strategy, and just think of it more so as in a technical analysis aspect, that momentum is a tool to help us with our trading. Okay, now that we understand what momentum is, let's now see how we can use it as an actual trading indicator, and where we can recognize buy and sell signals around that. So it's actually very simple to use and simple to recognize, which makes it a nice indicator. It's always nice to have indicators that are visually appealing and really helps to kind of confirm or strengthen your choices. By the way, if you're using a trading platform, a lot of times they may not list it as momentum per se. They might call it rate of change, or an abbreviation of ROC. So if you see ROC, that's momentum. That's the classic momentum indicator. And we're going to learn later about RSI, Relative Strength Index, and Stochastic Oscillator, and other types of momentum indicators, but this is the core kind of basic one that everything kind of builds from. So let's learn about that and use it as a trading indicator. So when you're looking at the part of a chart that you would add on to your regular price chart, actually, usually it's on the top or the bottom when you add it onto your price chart, and you would see like this kind of a little breakout, and it would look a little bit different than your regular price chart. I don't know if you're already looking at and see how it might be a little different here, or looking at Tesla and Procter & Gamble as a couple examples, and you can see they're different because they're different stocks, of course, they're different securities. But if you look at it, you'll see that the time is still the same. The oldest time is to the left, going to most recent time to the right. But if you look on the right-hand side, what is represented is not price. That's a real important thing. Tesla is not selling for, at this point, $35.94, and Procter & Gamble's not at 76 cents. So what it is, it's not a price, it's a percentage. And you have a zero line there. You see the zero line. And if you're above and below, it's a percentage above and below that price. And that will tell us things as far as being above and below the price. So if we looked at Tesla there on the top, it's at 35.94%. And then we're using as you see in the upper left where it says a rate of change, or ROC. So as I was mentioning, that might be what you will find on your trading software. We have it over 10 periods, which is a standard for using for momentum as far as over 10 periods. And so you might be thinking, if you start looking at this and say, okay, what might be important as far as deciding whether to buy and sell, hopefully you're looking at it and you're thinking, oh, maybe that percentage is important. How big the percentage is important, but really what might be important is whether it's above or below the zero line. Is it a positive number or is it a negative number? And if you were thinking about that already, great for you. If not, let's talk about that, because you're right on. The zero line equals the price basically X number of periods ago. So in this example, we mentioned we were looking at 10 periods. So the zero line indicates that will give you an indication how much above or below that percentage was 10 periods ago. So again, we're looking at acceleration, deceleration, we're looking at momentum. Again, not price on the right-hand side, it's a percentage. So you see it's a 35.94. So the signals that you want to be watching for, and where it makes it visually appealing and easy, is it's a buy signal if it crosses above the 0 line. It's part of signaling an uptrend. So if you look at Tesla here, you can see it crosses below and above the 0 line, several times or a couple times, but mostly it stays above that 0 line. So if it crosses above the 0 line, it's an uptrend signal, and it's a buy signal. You'd sell if it crosses below the 0 line. So that's basically signaling a downtrend. The percentages up or down or show you the strength around that momentum too. Something that just barely crosses over that 0 line, shows that it's an indication you might want to buy if it's going above it, for example. But it's the strength of it, if you wanted to wait to see, make sure to kind of confirm and let it be stronger to build out, higher above that line would show you more of a stronger number around that way. If we look at it, it's pretty simple, but if we look, sometimes it does diverge, where momentum and price move in the opposite directions, maybe ever so slightly. So if you see that, technically both are going in the same direction, because momentum is really measuring speed. It's more failure to confirm the price move if it's going a little bit in the opposite direction. So if you see this here in this example, it's above the 0 line, which is a buy signal, but it's just headed the opposite way slightly. If you look below to the chart, you can see where we've got our candles. Just slightly different. Might start be going sideways in the price chart, and you can see the momentum indicators kind of going along with it too a little bit. It's not a huge example, but it gives you an idea of what it might look like if there was a divergence going on. And you can also see that the volume in this example is really steady or low. So that's, remember, we would think of volume as a way of confirming things. So if this was a definite crossing below the line and volume was high, this would be an example, or rising maybe, and this would be an example where, oh, that sounds like a pretty strong sell signal, where this might not be as strong a sell signal or a change, going below the line. And as you can see, it kind of ticks back up a little bit, as far as going up on a little bit of an uptrend after we get outside that little red, rectangle bar I highlighted. But then it starts going down from there. And as you see it go down to the right, you'll see how it's now crossing below the 0 line up above in the momentum indicator. And that's what we're looking for, is when it crosses below, we want to sell and get out before it goes down further, is the idea. Here you can actually see there's a breakaway gap in here. I'll take, you can see the breakaway gap. As we remember from the gap lesson, it jumped way up as far as price, overcame the range of the previous, in this case, days. It could be minutes, hours, whatever your trading range is, but this is days. So you see it had a breakaway gap that was then reinforced with a little bit of a pullback there after 2 days, but then only for a couple of days, and then a strong trend going forward. And you can see how that the momentum indicator crosses above the 0 line right around that same time and then starts reinforcing that. So that's another way you can use to help reinforce that maybe your breakaway gap is really something that's going on. In fact, if we look at it a little bit closer here, you can see that not only is the momentum kind of confirming it, but also we have our volume as another confirming measure. So we can look at this and apply some of our different lessons and say, I've got a breakaway gap. I waited for it to develop, because you want to make sure the trend develops. I did that, so hooray for me, or for you. And the momentum indicator is rising above the 0 line, then certainly going well above it, so it's kind of confirming that. And the volume going from some very, very low volumes right before it kind of confirmed it. So if you see that, you've got really basically 3 indicators kind of confirming each other, particularly on something like a breakaway gap, which we know breakaway gaps are designed to lead to higher strong trends, right? So that's a strong indicator showing a strong trend going forward. So at this point, you should be very happy. Yay! That's a good strong indicator confirmed 3 ways. Again, nothing's perfect, but that's a really good strong indication you would have came across, confirming it with a multiple different things beyond just the breakaway gap, which might have been your primary indicator. So momentum is pretty easy to recognize on a chart, but there are a couple little things to understand and a couple little tricky things too, just to be aware of if you're using a momentum indicator. And you may think, well, when the momentum line is horizontal, you may think that momentum has stopped, that it's basically stopped in its tracks. And that's actually not so. It's actually the acceleration has stopped, or it's starting to slow down, and it's going to accelerate or deaccelerate or it's deaccelerating, and now it's going to accelerate maybe in a different direction possibly as it flattens out. It might go up or might go down, but it hasn't technically, the price hasn't stopped or the momentum hasn't stopped. And that's the other thing. When you look at momentum, your eye will naturally line up with the price. It's okay with that. We did a little bit of that in previous lesson. But and you think there's a strong correlation to that, what you're seeing on the chart, and that can be true for sure. That's the whole idea of using momentum, but it's not always true, as far as an exact lineup there, as we learned there. So that's something just to be aware of when you're looking at momentum. A couple other things too is momentum sometimes does mirror the price move, because momentum is tracking the closing price X number of days back, certain number of days back. So we're looking at that. It will appear as a smooth line, a smooth price line. And the more days in your look back period, the smoother the line. We had used in another lesson the example of 10 days. If we had gone further back, like 20 days, that will actually smooth out the line. So if you have some real highs or lows, some outliers, that will continue to smooth that out even further. But unlike the moving average, it does not include all the days in between. By omitting that extra information, the line gets smoother. So what I mean is, we're looking at 10 days back, we're looking at the price on that 10-day back. So if that was an outlier, that would impact your momentum, but it's not looking at the prices that are happening in between like a moving average would. And that's what we're talking about. However, if you have a one-day price spike, you may see a jump in momentum for a moment, but later you will see a sudden drop as the data is excluded from the series. So you have that one-day price spike. Let's say it's a price spike up. You're going to see your momentum indicator have maybe more of a change, maybe more of a dramatic change, and then it's going to account for that in the next day as it looks back at its look back period. So the spike situation is where it pays to look at price bars, right? We had a whole section around spikes and obviously looking at your open, high, low, close, or your candlestick price bars, and not just look at momentum, as that could be a little bit misleading. So don't necessarily trade just on the momentum indicator. Again, different than momentum investing, but it's just trading on the momentum indicator. In fact, I think where momentum really does well is using momentum. Some use it as a primary indicator, but I think it works best as a secondary indicator. So you're using another indicator, for maybe your price or you're seeing something form, maybe a doji or something like that. You're using a gap. We looked at a gap. You're using something else, and then maybe you'll use momentum to confirm that. So it's best to use it as another indicator. And if you're using it with another indicator, you can have your other indicator be the primary and then momentum be your secondary. Or you could also use momentum as your primary at that point, but you would use something else to kind of give you confirmation on it. It's really best with momentum to have some type of pairing and not use it just all on its own. Now, there are ways to adjust momentum or filter momentum too. If you shorten the momentum time frame, like we use an example 10 days, but if let's say you shorten that to real short, like 3 days, you'll be more responsive to price changes. It's going to be the more recent prices, right? It's only a 3-day look back as opposed to a 10-day. Again, it's only looking at that specific day. That's what momentum is versus a moving average. But the idea is it'll be more sensitive to those price changes. And if you have a shorter time frame, it's going to show more buy and sell signals. You're going to have more whipsaws, or you're more frequently trading, and you might have some potential losses based on false trend signals, or maybe some more expense there depending on how you're placing your orders, because you're going to have more trading orders. And that if you reduce your time frame as far as momentum to have it be more responsive. Another thing you can do with momentum too is you can filter it with a trading rule or apply a trading rule. So example, instead of buying or selling when the momentum line simply crosses the zero line, you could say you will take a buy or sell action only when the momentum line is crossed by more than 2%, right? So it's got to be at least 2% above that zero line or 2% below that zero line for a decision to be made. So now if you think about that, well, there's an opportunity cost by delaying for that 2% to be in place, and that's exactly true. That's what happens with filters. It helps strengthen your decisions, but it also costs you in terms of opportunity costs that you could have bought in. Let's say you could have bought in a little bit earlier and had a little bit more profit by getting in earlier than waiting for that 2% to happen. But again, that'll help eliminate whipsaws. It'll help reduce whipsaws, help strengthen your buying decisions, especially if you're coupling it with another indicator saying, all right, I see this other indicator, this primary indicator out there. I'm going to follow my primary. I'm going to use momentum as my secondary to confirm, but I'm only going to use my momentum to confirm if it's, let's say, 2% above the zero line and my primary indicator is still showing a buy signal. Now I feel confident to maybe make a trade, maybe even a bigger trade at that point. So that's another way that you can kind of start putting this together. And later in the course, we talk about how to kind of do this and start pairing up different types of indicators. And momentum is great to pair up with other indicators as well. So with that, that's the building block of momentum, and you can just trade right on momentum, or you probably see it as ROC, or rate of change, and that's very, very effective. But there's a couple other ones that I want you to take a look at here that are in the momentum family that build on that. And so let's look at those in the next couple lessons here, and then you can kind of choose which one you like best. All right, well, you may be actually saying to yourself something like, you know, Steve, momentum or rate of change is nice, but I don't want to wait as long to buy or sell before it crosses the zero line. I want to, you know, kind of get in there a little sooner. If that's true, then the very popular RSI is for you. So RSI, or Relative Strength Index, is a momentum indicator, and it's a much faster than the rate of change or traditional momentum as a signal that an impeding price change may be happening. So it's a good tool. How a lot of people use it, it's a good tool for profit taking, recognizing maybe my security's gone up in price and I've got some profit, and now I'm watching this RSI to see when I might want to sell or take that profit out, you know, because it's going to give me a little faster signal than, let's say, the traditional momentum indicator, or ROC. It can be less reliable, though, for buy and sell signals, so you have to kind of think about that as well. It's good, but it might be a little bit less reliable in terms of, you know, deciding the actual time to actually buy or actually sell. But it can give you an indication that something's changing, something's coming, you know. So you can use other indicators maybe to determine your buy and sell signal, like I'm going to buy or sell based on this primary indicator, but then I'll use something like RSI to kind of confirm that, say, yeah, RSI is a little less reliable, but these are real reliable, so I'm going to use that RSI as an additional confirmation, and then I'm going to make my trading move. So that's where RSI can be really powerful or strong in that way. As I mentioned, it's part of the momentum family, and so it means it's looking at the relative speed of the price changes, or how is it accelerating, deaccelerating. And the difference is it's going to use averages over several days rather than a single price point. So you remember from the traditional the ROC momentum lesson, or rate of change, it's basically, if I was looking at 10 days, I would go back 10 days and look at the price there for momentum in using that, the system, the platforms to automatically calculate. But it's basically a 10-day, in that example, look back. And just that, it doesn't care about what happens in between, it's just that 10-day one. RSI is nice, where it's going to use the averages over that period to kind of give you a better kind of look at, as far as the signal in terms of price points, and that is what helps it to be more sensitive, let's say, than a typical ROC, and be able to be more faster acting than traditional ROC as well. So for those who love math, you don't have to calculate this. The trading platform will automatically put you in nice little lines and charts, you know, on your chart. So, but if you're wondering, this is the kind of the calculation behind it, as far as there's a step 1 and a step 2 to kind of figure out the RSI. Or relative strength, or relative strength index is the combined to do. The one thing you want to take away from those is you can see from the math part of it is RSI is what's part of is momentum, but it's also part of what's considered the oscillator subcategory, subfamily on it. Basically, what an oscillator does is it converts the positive numbers between 0 and 100%. So if we remember rate of change, we had a zero line and we could be above 0 or below 0. There's no zero line. Well, there's a zero line, but there's nothing below the zero line. It's going to be all positive numbers. And most of those ranges, and most of those things you're going to see are going to range between 30 and 70%. And when you're actually seeing things on a chart, you're going to see that. Also, the default for RSI, as far as how it was developed, is 14 days, 14 trading days, is the standard for RSI time range. You could use other time ranges. You could use, 14 periods, so it could be 14, hours, 14 minutes, whatever you might want to do. But the standard was built around days, which is 14 days as a standard for an RSI. If you go longer than that, you're going to see more false signals taking you out of maybe a possibly longer trend if you're going longer. And if you go shorter, you might experience more frequent trading because it's going to give you signals to be buy, trade, buy, sell, more frequently. So 14 days seems to be the sweet spot when you're using an RSI, and I would tend to recommend just staying with that. It'll be a default in your trading platform. You can change it, but that would be kind of the default and what I would recommend using too. So what really RSI is telling us is it's going to really tell us about overbought and oversold conditions. That's a big thing that's going to tell us about. So if you think about an overbought condition, traders are thinking the current price rise trend is at an extreme, right? It's overbought. The prices have gone up to the top. And traders are starting to think, oh, it's starting to settle down now. There might be less people coming in to buy. It seems a little overbought. So we might be ready for a turnaround to happen at any moment where the prices are going to start falling now. So we might want to take our profits now. We might be getting towards the peak. Again, it's hard to predict the actual peak and trough of a price, but the idea is you want to get as close as you can. And so when you have this overbought condition, your RSI line is going to cross above the 70% line. So that's kind of the magic number, the one you kind of keep in your head, and we'll show you in the examples here coming up. But when it crosses above the 70% line, that's showing there's an overbought condition. And if you own the security now, it might be time to sell. You can use as a primary. You can use the RSI as a primary tool to be watching for these overbought conditions, or it's also really good as a confirming indicator too, using with other indicators. Oversold conditions would be kind of the exact opposite. Traders think the current price has fallen to an extreme. It's gone way too far. And there's few sellers right now, and the price is relatively cheap, and people are not willing to sell anymore. They just think it's gotten way too low. So it might be ready for a turnaround in terms of going back up. So buyers are starting to come back in, and as it starts to go back up, even more buyers will come back in, particularly if a trend forms, you'll start seeing a lot of buyers coming in and really drive that price up. So with the RSI, a security would be oversold when the RSI crosses below the 30% line. So above the 70% line, overbought. Below the 30% line is oversold. Again, you can use that as a primary, or it's also actually very good as a confirming indicator. Also note too, in terms of overbought or oversold, that when trends are strong, the stronger the trend, in securities can be overbought or oversold for longer periods of time. And that makes kind of sense, right? We've already got this long period of this strong trend that's well established. People are going to be a little less reluctant to get off that train, to get off that trend train, because it already looks very good. So by using RSI, we can kind of recognize, hey, the train might be coming to an end here, or might be coming to the station, time to maybe sell my security. So if we own it, let's say in an overbought condition, like, oh, okay, you guys are still excited. We've been having the strong trend for a long time. I've got another indicator saying, a turnaround might be coming, and my RSI is telling me a turnaround's coming. Might be a great time to get out. So that's how you can kind of use it as far as that relative strength index, looking for those overbought and oversold conditions. And that 70% and that 30% line are the key parts to that. Let's take a look at that. So if we look at this sample RSI chart here, and as we know, the relative strength index, if the lines are crossing below 30%, that means it's oversold, and would be a buying opportunity. And if the RSI crosses above 70%, that's indicating that we're looking at an overbought situation and a sell opportunity. And in this example, and the ROC, of course, is related to the zero line. So this is not on here yet, but we'll talk about the comparison with the rate of change in a moment here. But as you can see, on this particular one, it never does get to the 30 line. It never does even, it gets close. It gets around 50%, which is an indecisive area. It could go either way. But if we look at this particular chart, it is telling us that there are periods where it's above 70. You can see in the far right where it's in the upper left too, it says 83.11. That's the actual measure. So not only is it above 70, it's actually quite above 70. And in this particular chart, it colors it in, which is nice to be able to visualize that easily as well too. So those would be, traditionally it would be like a sell type opportunity when you see that. If we use the same security and now we put below the RSI, we put the ROC, you can see how they follow along very similarly. As far as the movement of the lines are very similar in pattern. The ROC, of course, is going to use that zero line. And if it crosses above the zero line on the ROC, as we recall, that's a buy signal. If it crosses below the ROC, that is a down or an uptrend signal. And if it crosses below the zero line, that's a downtrend signal or a sell type signal. Now, if we look at these together, one thing that you'll see here is you notice how in the ROC, how it goes above and below the zero line
pretty frequently they're in the middle. That's that whipsaw effect where it's going whipping above and below the line, causing a lot of frequent buy and sell signals. And the RSI above does not have that. Remember, the RSI is at 70 and 30. If you look at that same part of the chart, there's no buy and sell signals. It's really truly showing that there's a period of indecisiveness. So you wouldn't be as actively trading. You wouldn't be potentially taking on more either for fees or more potential for short-term losses around this because it's filtering all of that out with the RSI. And that's why a lot of people really prefer the RSI from that aspect, as it does tend to take out those whipsaw actions, as you can see in this example here. So RSI's, a relative strength index, is extremely popular. Many times it is a default, when you go into a trading platform, and they might automatically put things like candlesticks in your chart, or they might automatically put other types of indicators in your chart, or above or below the chart. RSI is a very popular one that sometimes is a default. So that means it's very popular, very useful. A lot of traders are looking at it, and a lot of people use it as sometimes as a primary, but a lot of times I like to use it as a confirming something else. So RSI is great. So take a look at RSI as being part of that whole momentum indicator family. Another great indicator that you can use to really identify overbought and oversold positions is the stochastic oscillator, which just has kind of a fun name too, doesn't it? And since it's an oscillator, we know that the numbers are going to be positive numbers from 0 to 100%. Again, not going to show the price, it's going to show a percentage from 0 to 100% that you're going to use to evaluate. And we're going to show you that in a moment here. Oh, by the way, too, there's actually kind of poorly named. Stochastic actually means randomness. And what we're trying to do is find out order and patterns, right? And then it does help us with that. So I don't know why they chose that name, but it's not the perfect name for it. But it's a good momentum indicator. So let's take a look at the stochastic oscillator. So what it does is it looks not only at the closing price, but also how near is that close to the high or low of the day. You saw on some of our other types of momentum indicators, we're really looking at closing prices in a look-back period, and whether that's a certain day or an average. Where this is going to get a little bit more mathematical and also look more how does it reflect both the high and the low of the day as opposed to just closing. So for example, if you have a close, the closing price is near the high, and each high is higher than the day before. Not only do you have an uptrend, but you have an uptrend that is accelerating. It's getting faster, it's getting stronger. So in a rally, prices will keep going up like that. Prices will keep going up, and you expect the price to close near the high of the day. In a sell-off, the opposite, prices are going down. You expect the price to close near the new low of the day. So in the example and in this little description, you can kind of see we're trying to measure, how strong are these trends? Are they accelerating? And stochastic oscillator, using that mathematical equations behind it, does that for us. In fact, if you're curious about the math behind it, here you go. Again, the trading platform will automatically do this for you and automatically, put the lines on the chart there for you, so you don't have to worry about doing the calculation. But it is an interesting calculation. There's some parts you need to kind of, know about on there. One is you're going to see, because you're going to have some inputs later here, and we're going to talk about that, or some choices here in the next slide. First off, when you see something that says percentage K, that is the stochastic oscillator. So that if you're looking at percentage K, that's the indicator. And then it's going to be compared to a 3-day simple moving average, how the formula was developed there back in the 50s. And that's going to be identified as percentage D. Don't worry, there's nothing else in technical analysis that has a percentage K and percentage D or gets weird like this. But on your chart, you're going to have these two lines, and they're going to be labeled percentage K and percentage D. Again, the percentage K is the stochastic indicator, and percentage D is a comparison to the 3-day simple moving average, and you're going to look at these two lines in tandem. Now, let's get to the worst slide of the course. Well, maybe not the worst slide, but they make it a little bit more complicated for you, if you want it to be. So there's 3 common types of stochastic oscillators you can choose from, and usually these are all on your trading platform, and they're labeled a little bit weird, so I want to make sure I covered that for you. So you're going to see them labeled as fast, slow, and full. I wish they had better names, but that's what they call them: fast, slow, and full. So the fast stochastic oscillator, that's the original one. That's the original one we just looked at as far as the mathematical calculation. That's the basis. That's the basis for everything. So that's the base. Then you can choose something like a slow stochastic oscillator, which will help make your percentage K look a little less choppy. It smooths out even more. And you can see how the formula changed a little bit more. They added a smoothed it out with a 3-day period SMA built right into the percentage K, and then comparing that to the 3-period SMA of the slow K, or slow. It's this 3-day SMA basically is what it is. It's the slow percentage D. So what you're really getting with the slow one is a little bit less choppy of lines. You see them a little bit more choppy. You want to smooth them out, a little bit more. Then you could use a slow stochastic oscillator. And then there's the full stochastic oscillator, and all that really does is allows you to customize the number of periods. As remember, the number of periods is a kind of a default there. And that default is 14 days. If we were to look at the formula back in the previous slide, it's a 14-day default. So, but if you wanted to change that from 14 days, you can put in whatever number of periods that you want. And that's really what the full stochastic oscillator does. This gives you more flexibility in days. Again, a lot of research on things around stochastic oscillators. 14 days chosen for a reason. So it matches up with RSI, similar type thing. So you might want to stick with that. I would certainly recommend it. But you can also, it's perfectly fine if you become more comfortable with your trading. If you want to have more customization, you can certainly do that. I will tell you that most people use the original formula in the original format, or so they're choosing in effect, the fast stochastic oscillator if they have a choice on their trading platform. If you don't see choices, usually they give you one. But if you don't, then just if it says stochastic oscillator, understand that is the original formula and that is the fast one. Again, wish better names. So if we look at it graphically here, you're going to have your percentage K, the stochastic oscillator, and then your percentage D, which is that 3-day simple moving average of that percentage K. So it's a relationship between the two. And what it's going to do is it's going to generate two lines on your chart. You're going to see, you can kind of see here where it says STO, stochastic oscillator. The percentage K is 14 days. That's the default. The percentage D is 3, because that's the 3-day simple moving average. So that's the default too. Generates two lines on that, and you can see the two lines here right on the chart. And you can see that they kind of move a little bit in tandem, and you can see how the 3-day one, the pink one, is a little bit more smoother versus being less up and down. So that's because it's a shorter look back period. If you were to customize these and put, let's say, an 8-day as for your percentage K, if you did customize it, it would then smooth out that percentage K a little bit more. But we like to use the default here, so that's what it kind of looks like as far as the default. All right, so that's great. Now, how do we use it? Well, here's how you use it, because you're trying to, again, recognize these overbought and oversold conditions. Overbought, traders think the current price rise is an extreme. It's too high. We're ready for a turnaround, and so we want to take our profits now. We're reaching the peak. So an overbought is indicated when the stochastic oscillator crosses above the 80% line. So in this case, you're looking for the 80% line, and you're looking for it when it's overbought, and you want to look for that. You're looking for it to be above the 80% line, and you're going to actually make the sell decision that it's overbought when the percentage K crosses below the percentage D. Okay, so you got two things going on here. We're looking for that overbought condition, and then we're looking for a sell signal, and that's going to tell us when we think we're getting really close to the peak, and that's that percentage K is going to cross below the percentage D. The overall or an oversold condition is when traders think the current price fall is an extreme. It's gone way down in price. There's few sellers, and the price is relatively cheap, and it's ready for a turnaround. That we're thinking buyers are going to start coming back in. And how we see this with a stochastic oscillator indicator is an oversold is going to be indicated when the stochastic oscillator, the percentage K, is below the 20% line. So there's no below zero. Remember, it's an oscillator, so it's between 0 and 100%. And there's no prices. It's a percentage, so it's going to go below the 20% line. And we're looking for the percentage K to cross above the percentage D to give us the indication that's the time to buy, right? So it's kind of like these two kind of sets of conditions that you need to meet for it to be kind of implemented. So if we looked at this again graphically on here, you're selling when the percentage K is above the 80% line, showing an overbought condition, and it's crossing below the percentage D. Now let's look at that visually on the chart there. And the same thing, you're going to buy at the low part when it's below the 20% line and crosses above the percentage D. So you can see where we have highlighted real strongly the blue lines there for the 80 and the 20% on the right hand side. And you can see in this example with Tesla, there's conditions where it does that, where it's above or below, and it crosses over each other to kind of confirm the pattern within itself. And there's times when it's in between, and then you're taking no action at all. It's just neither overbought nor oversold. It's just kind of waiting for something to happen. Well, either a sell signal or a buy signal for that to happen within there. And in this view, you have the price chart on the left, and on the bottom of the left, and on the top is the stochastic oscillator. And you can see where the lines are crossing the 80 and 20% line, and also when they're crossing each other. And you can kind of see where that's happening, where it's looking at the chart itself on the right-hand side there, when that starts to kind of match up. And again, you want to have those two conditions be met, and that's the whole idea, is you're trying to anticipate these buying and selling conditions. So if we look at the chart on the right, you can see where our once we cross, actually when the crossing happens, that's when we see we're on this uptrend firstly, and we see the cross, it's above the 8% line, it crosses below, and that's where we're going to sell. And then as it indicated, the indicator worked and it showed a downtrend from there, then it flattened out, and then we saw we're kind of bottomed out. And as we saw it start to rise above that 20% line, we saw a buying condition, at least for a short period of time, where it might have been in a buying area. So that's another way that you can kind of look at these two as far as with the price charts. But a great way is to start just with your stochastic oscillator, be watching that, and then confirm it with other types of price indicators. By the way, we talked about fast, slow, and full stochastic oscillating charts. Fast is the original, with a 14-day. The slow is one that uses the original and kind of smooths out that 14-day price. And a full one is the one where you can input your own numbers. So if you look at the first two ones here, it's the exact same chart in the exact same time period. And you can see that the one below, the fast STO, or stochastic oscillator, a lot more jerky up and down, a lot more up and down there, not as smoothed out as far as the black line. If we make that into the slow one, you can see how it now adds an extra smoothing factor with a factor built into the equation, the SMA built into the equation, the simple moving average, in addition to the percentage D. And so that makes it a little bit easier to read and see as far as when these lines might be crossing. So sometimes you might see something using your traditional one, your original one, and then it's just a simple click of a button or two to overlay it with a slow one or replace it with a slow one to kind of see it a little bit better visually. Again, the full one on the bottom that's all customized between them. So whatever you put in is going to have a dramatic input on the chart. I used the 10-day for a shorter look back to see if it was more price sensitive, which would be more price sensitive by using it in a full STO. So if I like it, but I want to be more price sensitive and even more reactionary, then I might put in a shorter time period versus, let's say, a longer time period. So as you play around with this, you can kind of get an idea how they look. I would say most people, they're using the traditional, the original STO, or it would be termed as a fast, and then they might use the slow one to just kind of see it a little bit visually right before maybe they're decide they're going to do something. They want to just make sure they're seeing what they're seeing a little bit clear, and so they'll use the slow one in that aspect. So we learned some powerful momentum indicators, some oscillating indicators that can be really, really good. And you might be asking yourself, okay, what's the difference between an RSI and the stochastic oscillator? What's the difference, and is there a better time when I should use one or the other? And that's what we're going to talk about in this lesson. So first off, let's talk about their similarities, because it's more similar than different, actually. So with the stochastic oscillator and the relative strength index, they are both widely used. So they're both widely used. They're both very, very popular. They're both momentum oscillators, so that means it's going to be between 0 and 100%. So they're all going to be percentages, and they're all going to be positive numbers. They're really looking at these overbought and oversold situations. That's what we're trying to identify as we get closer to peaks and troughs of overbought and oversold securities. And they're simple to use. They'll simply, you can just choose your parameters, or just choose it, and it'll overlay the graph, and you can just watch for the as we learned in the previous lessons, you can watch for the conditions, the buy and sell signals. And they're really good to use to confirm with other indicators. So if you're using something else as your primary indicator, a candlestick pattern, a chart pattern, maybe a moving average, whatever it might be, these oscillators, these stochastic oscillator and relative strength index, are good to use to kind of confirm what you're seeing. So really what the big difference is and how we might apply that is under the underlying philosophy, which gets into the math, which gets into the calculation. Again, you don't have to calculate on your platform, but if you think about it philosophically, this is where the difference comes in. The stochastic oscillator is predicated on the assumption that closing prices should close near the same direction as the current trend. So if you've got an uptrend, you should have uptrending closing prices, and that close should kind of close near that same direction or in that trend. So it emphasizes that trend part of the closing prices. This RSI is designed to measure the speed, the acceleration or deceleration of price movements. They both kind of do that a little bit, but RSI, that's really all about speed. That's really where it shines and where its strength lies as far as in that. So the key is which to use when. Is there a strength of one over the other? Well, they're both actually very good in what they do. That's why they're so similar. So it's more the similarities. But if we were to nitpick and say, well, if we were to really say, oh, okay, what's the best for each of these versus they're both good in any of these types of markets as an oscillator, as a momentum indicator, a stochastic oscillator tends to be best for choppy or sideways markets. Where there's no great trend identification. There's nothing great where you've seen a trend be identified, because it's trying to help identify, or it's kind of helping you decide whether it's overbought or oversold, and there's not a clear trend. And so if it's used in a strong trend thing, sometimes that can cause a premature exit. Let's say if you're in a strong upward trend and it's accelerating, the stochastic might not show that as much, and you might exit a little bit sooner with a stochastic oscillator. As opposed to, let's say, the relative strength index, which is really great for trending markets. Is it accelerating that trend? Is it keeping getting strong? Or is it decelerating that trend? And that trend could be either up, an upward trend or a downward trend. But it's really great for those markets. Now, as we saw in the lesson RSI, it can also help reduce the choppiness and things of whipsaws that a standard momentum, the basic ROC or rate of change momentum indicator uses. But if we were, and that's why stochastic oscillators and relative strength index are both, I would say, better than the momentum indicator overall, depending on how you use it. But that's just an opinion at that point. But the RSI was good for identifying and taking you out of that less trading range too. So this is again all real kind of nitpicky stuff, real kind of detailed stuff around it. But I would say certainly if you've got a market that's really trending strongly or trending and you're working a trend, I would definitely tend to rely on that RSI. Stochastic oscillator can give you those false signals in those trending areas. So really the big takeaway from this is if it's a strong trend, either way, use the RSI. One thing that's somewhat unique to cryptocurrency in terms of analyzing prices and what's going on with buyers and sellers in the market itself is a depth chart. And if you look at, you can see in the image here, it looks kind of like a canyon, right? You've got the two canyon walls on the sides, and then you go down and there's like a little canyon in the middle there. And it's constantly changing before your eyes. This red and this green colors, they constantly change. It can be actually a little mesmerizing if you're watching it, but that's kind of what it looks like. So let's take a look at what does this mean and how can we kind of use it? So what the depth chart shows is it's showing current orders that are out there. People who are buying and selling. And the y-axis, up and down, the vertical axis, is the number of orders that are out there, right? So you can see it goes from 0, and in this case goes up to 5,400, 5,400 different orders for this particular cryptocurrency, for example. So the up and down vertical is how many orders are out there, and then the x-axis or horizontal is the price. So you've got how many orders up on the side there, and along the bottom is the price they're willing to pay at these different levels. And then the colors, the left and right, means something too. On the left is buyers, represented in green, and on the red is sellers. So you'd have buyers on the left, sellers on the right, and they're meeting in the middle. And that's what your mid-market price is kind of where it's meeting in the middle and where trades are happening right now. Again, this is constantly changing throughout the trading day. And so you can see if, let's say, prices are rising, you'll see that mid-market price go up, and if they're falling, you'll see that mid-market price go down. But the shape of the canyon, so to speak, continually changes as well. And then note that you see, and this is very common, where you'll see some gradual slopes around the market price, because people are starting to really start to come together. And then you'll start hitting walls, where you have large walls, like in this example, you can see you see the large sell wall at 260. In this case, we're using dollars, could be your own currency, and you can set these different things for your currencies or your cryptos. But there's a sell wall in this example at $260. See how you have that straight line going straight up? And that's showing that there's a lot, at each of those levels, there's a lot of people who are willing to sell at 260. They don't want to sell at 259.09. We've got some people at the bottom of the canyon there, but there's a lot of people willing to sell at 260. So if you make a bid or an offer or gets matched up at 260, you've got a lot of liquidity there. People are going to sell because they've already set up their orders. These are existing orders, current orders, so they're willing to sell at 260. If you look at the green one, you can see to the far left, you can see how there's a lot of people at the 255 range. See how that's there, where it's a real tall wall. So you hit 255, you've got lots of people are willing to sell, lots of people willing to buy. But all those people in that long line there at 255, they're not willing to buy at 259. So those orders are still out there. They're still current and they're out there. So the depth chart is kind of showing you, kind of what's going on in the market as far as, is there a lot of buyers and sellers, and at what price levels too. So if we look at another example here, here's at 46.085 is the mid-market price. And so there's a green wall at 45.7, but then there's this big, massive red wall at 46.5. So we're getting close there, but there's a lot of sellers at that price. See how that canyon really looks different? And so you have to get kind of through that resistance level. There's different levels of resistance to get through, before you can get somebody to, let's say, buy. In this case, if you want somebody to sell to for, let's say, I don't know, 47, you would have to get through that big wall of people trying to sell for 46.5. Or excuse me, actually sell for less. It would be the opposite way because it's a seller. So people are willing to sell at 46.50. You want them to sell for less if you're buying. They're not going to. They're sticking it out at 46.5. So there are some sellers selling for less, as you can see. There's people at 46.085 in the middle, and 46.1 and 46.4 are looking at the red side there. And there are some sellers, but you can kind of see where all of a sudden you're going to have a big market movement if we hit 46.5, because if it gets to that, there's going to be lots of transactions because a lot of these sellers are now going to come in, and a lot of buyers are going to be matched, and we're going to have a lot of volume or traction around that. So give me an idea of these depth charts, kind of how to look at them, what's going on, and understand these different walls that can appear and what that kind of means.